Hi, good afternoon, everyone, or good morning, depending on what coast you're on. Thank you so much for joining us today. Welcome to the Quarterly WellCents Show. My name is Kelly Brunsheen, and I'm a WellCents specialist on the WellCents team. As we get started, if you have any questions, feel free to type them in the chat or in the Q&A tool located on the Zoom toolbar. You also have the option to email our financial professionals directly at planning@mywellcents.com. That's planning@mywellcents.com, and they'll follow up with you directly. So without further ado, I'm so happy to introduce our financial professionals, Stuart and Brian. Take it away, guys.
Thank you. Hey guys, good to see everybody again. I recognize some faces that have joined. We're looking forward to getting you guys some good information. I know we had a lot of good feedback from the last quarterly we did going over taxes during tax time. Again, for those who aren't familiar, I'm Brian with NFP. I'm one of our certified financial planners. I've been doing it 20 years. Stuart and I consistently speak to our 401k participants throughout the year and our personal planning clients, and we're certainly in a different year. Right, the market's down a good bit. Stocks, bond funds are down a good bit, especially intermediate long-term bond funds, and inflation's continuing to rise. We're all seeing that at the food stores and the gas pumps. So today's agenda is really just to, continue and do a Q&A and go over some talking points. We have some of our fund managers here today to kind of figure out how do we invest during this inflationary period, especially when a lot of things, there's a lot of volatility in the market, and we look forward to going over that with you. Let me turn it over to Stu, and he'll give a little bit of background and introduce our guest speakers, and we'll go from there.
Yeah, thanks, Brian. So excited to be back with you all. Stuart Scholten, I'm also on the NFP team as a financial advisor. Have been with NFP for 10 years now, believe it or not. I know we don't look it, but they grab us early and they keep us around at NFP. I've met with a lot of you, I feel like, in the one-on-one sessions we've done through the WellCents meetings. If you haven't booked a session before, the reason you're getting this invite is because you are your company is paying for the WellCents service, which gives you an opportunity to meet with financial advisors like Brian, myself, to talk about your personal financial situation. So that's a really attractive service to obviously take advantage of and really help make sure that you're dialed in for your long-term planning goals. So that's ultimately what I'm here for, what Brian's here for. Without further ado, I want to introduce our guest speakers today. I've got Roger Nieves with PIMCO, and also Chris Dillon with T. Rowe Price, a couple of the big fund managers that you might know and hear about regularly in the news. Roger, I'll start with you. Give us a little background on you, how long you've been with T. Rowe, or PIMCO, I should say, and ultimately kind of what things are looking like right now in the fixed income space, real high level.
Yeah, no, thanks a lot, Stuart. Yeah, I don't think T. Rowe would take me, but anyways, it's great to talk to you guys. I've been with the firm for over 21 years, have run some businesses here in the U.S., run our Latin America business, worked with institutional clients, wealth management clients. I'm currently a senior advisor to our advisor education team, where I do talk to investors and of all stripes about what's happening in the fixed income markets. PIMCO's been around for over 50 years. And we currently manage over $2 trillion of bond assets for different types of investors, central banks, insurance companies, individuals.
Awesome. Chris, give us a little insight on yourself and T. Rowe.
Great. Thank you, everyone, for joining the conversation. Stuart, Brian, thanks again for having T. Rowe Price. Roger, if you're ever looking to make a change, I think we could find some room for you at T. Rowe Price. So let's get that out of the way. But hey, it's great to be here, and I'm with T. Rowe Price. We're a $1.7 trillion global investment management firm known for active management, fundamental research. Within that 1.7 trillion, 480 billion of that is T. Rowe Price multi-assets. This would be retirement dates, target dates, globally diversified solutions for our global investor client base. I think I have the best job at T. Rowe Price. I reside within T. Rowe Price multi-asset. There I get to sit within multi-asset strategy meetings. I get to see what T. Rowe Price equity division is thinking about stocks. I get to see T. Rowe Price fixed income. I sit within multi-asset. We also consult with the street. My job is to pack all of that into an informational snowball, have conversations like we're having today. I think in terms of the market, this is a good time to reflect and take a step back. Double-digit negative returns in markets, reasons for angst, Federal Reserve raising interest rates, high inflation. But we've had an extraordinarily great decade for investing here in the United States. If you take the clock back March of 2009 and you simply invested in the S&P 500, if you were to just tally that up and look at what your scoreboard was, you have earned 17% per annum on average for that period of time from March 2009 until now. Go ahead and forward the clock to March 23rd, 2020, when it felt like the world was ending with the pandemic, and think about the S&P 500, and it's delivered 81% total return since March 23rd, 2020, contributing to this great period for stock returns. A little bit of a pause here. Money is no longer free. We began the year with a 10-year treasury yield at 1.5%. Today, we're hovering in the range of 2.80%. We're of the mind that Fed funds, that policy rate, which has been practically nothing, potentially on its way to 2.5%, 3%, 12 months from now. That changes the price of stocks. This is part of that -16%, -17% number that we're experiencing right now. The good news is we've had this great run. The market is having a pause, recollecting itself. But to the extent that we get through this, active management is back. And I just think that the go-forward takeaway is expect lower returns, but we will get through this environment. We've been here before. It's just the price of money is no longer free, and it's causing pain in the market. But we do see an eventual other side to this. Thanks again for having us.
Yeah, I mean, I think, Chris, you're kind of making the case for us, and we tell everybody, I know Brian does as well. It's like you got to stay invested for the long haul. We look at these value drops of you said 15 to 17% in the last 5-6 months. That's not indicative of what the last 10 or 12 years looked like, right? So the real importance is staying invested for the long haul. I want to take a step back and, maybe Chris, and then I'll turn it over to you, Roger, on the fixed income side. But, for everybody on the call, give us a real high level overview of like, what's the role of equities in a portfolio specific to, we'll say, retirement assets, because I know everyone here is probably investing in their 401k on this call. Like, what's the role of equity in a portfolio? What should people be thinking about when they're choosing that particular, subset of categories?
So just trying to, I'm pausing on the question as I want to just have a concise, simple answer. Look, we're invested in capital markets to stay ahead of inflation and maintain our attractive way of life here in the United States. And, for the longest time, let's call it pre-pandemic, I think the 5-year average for inflation was somewhere in the range of 1.7%. So not a lot of inflation. We've had a world of deflation for the past couple of decades. So, earning money in the stock market, it's just up and over that rate of inflation. And that just allows us to enhance our wealth and maintain our style of living and keep us ahead of that cost of inflation. Real earnings or real total return is what equities provide. I think from the fixed income side, and I am not going to steal any of Roger's thunder because he's coming from a heavyweight fixed income shop, but I will say this, the yield that you get or you see on a 10-year treasury yield is normally a pretty good proxy for what you're going to get from the bond market. And to the extent that right now we're hovering at the range of 2.8%, we think that, stocks can do better than 2.8%. With that said, we have these moments in time where, where there's air pockets for the equity market. During the past 20 years, normally the bond side of your portfolio are the sunglasses, if you will, when the sun gets too bright on the equity side. It's diversification. You need both bonds and stocks. You get greater return from stocks, but they come with much greater risk. So the two work together, but stocks come with more risk, but they outperform bonds over time. Jeremy Siegel, stocks for the long run. What do you expect from stocks? 6 to 8%. I think from the bond market perspective, it's going to be 100 basis points of less than that, but the two work in tandem. I think the most important part or challenging part of this environment from the year to date and the trailing 12 month is that bonds and stocks have been selling off together very much from the year to date perspective. But we're getting to the other side of that where bonds and stocks are going to live together again. Greater return from stocks, greater risk. Fixed income helps balance out that ride.
Yeah, Roger.
I got a quick question for you. Again, for a lot of our 401k participants on the line, I get this question quite a lot is, should I still be in the target date? Should I try to go in and pick the individual funds? Because the argument tends to be a little bit, large cap growth is down close to 20, but large cap value is down half of that. Right. So as far as, an inflationary environment, more people are starting to look towards large cap value. Is that kind of where you and your analysts see things, or is that more of a temporary blip in the first 5 months of the year?
Brian, I like the question. So, and I think of this like from multi-asset perspective, we're looking at markets from 10, 20, 30-year perspectives. And we have a framework for a globally diversified portfolio. But Brian, you bring up a point. There's an ebb and flow to the market. And there are moments in time over 6, 12, 18 months where certain parts of the market become more attractive than the broad market itself. So we have this globally diversified framework, and not just call it 60% global equities, 40% global fixed income. But in T. Rowe Price multi-asset, we're looking at the world on a monthly basis, and we have a global research platform to inform T. Rowe Price multi-asset. So from 6, 12, 18-month perspective, we will turn the dial to different parts of the world, different parts of the style construct. Brian, you mentioned value versus growth. For the past decade, it's been growth, and it's been nothing but growth.
Yep.
But, the pandemic certainly threw a wrinkle into that. And there's been this, expectation that we reopen on the other side of the pandemic. It's become confusing. But the extent that you get accelerated economic growth, like last year, U.S. real GDP was 5.7%. And really since the summer of 2020, once there were rumors that vaccines were coming amid the pandemic, expectations for better growth and then higher interest rates eventually getting here, it's been value over growth. So in T. Rowe Price multi-asset, we overweighted value in the summer of 2020, and that's worked exceedingly well. It's an example of globally diversified portfolio, but there's a nuance in here that we can take advantage of from a near-term perspective. I guess I'll fast forward to now where it's a slowing domestic growth environment, global environment. We're not going to be throwing any more money at value, and growth has had a real big setback year to date. I can see us turning the wheel back to growth. So I think that's multi-asset. But for the individual on this call today, please use the target dates, the retirement dates as your core portfolio. And then certainly keep apprised of markets, work with partners such as yourself. But there are opportunities of the market where you can complement your core. Brian, that would be my answer to your question.
Great answer. Thank you.
Yeah, so I think that's a really good just synopsis of kind of where things are at, and obviously there's some bifurcation of where things are going in the equity space. Roger, I think bonds a lot of times are often overlooked and probably have been overlooked for the last 10 years, and it's really been a low interest rate environment for a lot of us just of recent memory. I mean, you go back a ways now, you've seen rates a lot higher than this in your career. Talk about the role of fixed income, kind of where do we think rates are going? If you could get your PIMCO crystal ball out, like where does it really tie in for somebody who maybe is looking for that less volatile asset class, but still wants that yield?
And Roger,
Yeah.
on that note, real quick, let me jump in real quick. Just one more thing, because I get from the same thing from all of our clients here is, the old 60-40 adage portfolio, right? As Chris mentioned, as stocks and bonds kind of go down together this year almost, at least until the recent last 2 weeks, and stocks had a tougher time, is, how do we that fixed income generally, right, for most investors, I'm under the understanding, right, that if the stocks are going up, the bonds are going down, and they have an inverse relationship. This is kind of the first time in a while we've seen them kind of both go down together. So how does a client of 401k kind of mitigate that and, get over the concerns of like staying the course and making sure they're in the right type of fixed income for what their plan is?
Yeah, so look, I know we've got several hundred people on the call today with different levels of understanding of what bonds are, how they work, maybe just taking a step back and just saying what is a bond, right? A bond is essentially a loan. And if it's a loan, then the next question is, well, who the heck am I borrowing money from? Well, you borrow money from the US government, or you borrow money from corporations, lend money to them, and in return, you receive an income stream for doing that, right? And that makes bonds a very, very different animal from stocks, right? There are your sleep at night money. It is what, to quote our fellow Californian over here, Will Rogers, from a long time ago, who famously said, sometimes I'm more concerned with the return of my money than the return on my money. I used to go down to Latin America and visit, the Central Bank of Colombia, who had a very, meaningful percentage of their wealth invested in government bonds, because that's the allocation where you really can't take a lot of principal loss. And overall, bonds really play three roles. One, protect principal. Two, generate income. And as Chris said earlier, the best predictor of returns for investing in a bond or a bond fund is that starting yield. In fact, the correlation between long-term returns and starting yield is over, 94%. That's like, the first Moderna vaccine level of effectiveness in the early days. It's really, really, really high. And then the third role is, as you mentioned, is equity diversification. So zigging when the stock market zags. And this year they've been kind of zagging together because both stocks and bonds have been hurt by inflation fears, geopolitical risk, supply chain disruptions. However, in the long run, you really should expect there to be some very nice diversification benefit from investing in bonds because they're just an entirely different animal. And I know, like you said, Brian, it's been only recent amount of time here, but I was on my Peloton bike on 5 a.m. on Monday morning, and you're watching the market, the 10-year tick up to 3.2%. And when fear really takes hold, right? When stuff really hits the oscillator, to not use too colorful language, it is that flight to safety that you'll see in fixed income start to exert downward pressure on yields, causes your bonds to appreciate because it's the port in the storm, right? Even if you think about it from like a corporate bond perspective, right? A corporation like Ford will have one class of common stock outstanding, but can have 100 different bond issues outstanding at the same time all over the globe with different legal protections and seniority. And if God forbid Ford gets into trouble, they're not able to navigate this movement to electric vehicles as well as their competitors or whatnot, and you have stress, it's the bondholders who get paid first, right? It is that legal structure that provides protection to bond investments, not to mention, again, that whole class of bond investments that are guaranteed by the government. So it really is about, as your plan participants on this call think about their allocation, think about it in terms of safety. And, sometimes, also the wealth protection. There are some people on this call who have significant amounts of wealth, right? I've worked really hard to build my nest egg, and I need to protect it from going down. So I need a slightly safer allocation, and that's kind of the role of fixed income. Now, in terms of where we go from here, let's go back to that starting, that correlation to starting yield. You're now able to get 3.5%, 4%, 4.5%, 5% type yields in certain investments. So if you have an intermediate time horizon, you're pretty insulated from market movements because you're able to hold your bonds for a long period of time and really, really capture that income. And in fact, if you're a really long-term investor, if you're looking out 10 years or whatnot, you're actually continuing to cheer these yields moving up, right? Because you're going to capture more and more yield in the years ahead. So, I think the key maybe for folks is if you have a shorter time horizon, invest in shorter maturity bonds. If you have a longer time horizon, invest in longer maturity bonds with some, credit risk or some extra sources of yield to help, kind of balance out your portfolio.
And Roger, for
Brian,
folks, oh, go ahead, Chris.
No, it's just, I like some of Roger's comments there, and I was just going to give a multi-asset T. Rowe just a very quick take. We have a decision. Our neutral is 60% global equities, 40% global fixed income. That is our neutral. And right now we're overweight fixed income a little bit, and we're thinking conventional fixed income. You get to this 3%-ish 10-year treasury yield, and then you're getting even more spread from the corporate bond market, the high yield bond market. Roger mentioned 3.5%, 4% type yields. Those are attractive yields, and I say that relative to one question that came in our queue, which is the question was, are we in a bear market? And of course, a bear market on the equity side is a minus 20% drawdown in the equity market. And year to date, we're minus 17.5%. So we've had a correction in the market. To the extent that we get minus 20%, we are in a bear market. So one of the reasons why we're underweight stocks here a little bit in multi-asset for reasons that Roger has talked about. But in terms of like how far this could go in the bear market, we're 3,900 points in the S&P 500. Federal Reserve is raising interest rates. There is some over optimism on earnings expectations for the S&P 500. We can go lower on the S&P 500, and then for reasons that Roger just talked about, fixed income looks attractive here, and it looks even more attractive in that strategic standpoint. So I just wanted to link in with Roger here relative to the question of bear market, relative to coming full circle to where we are right here. Thanks, guys.
And Roger, we get this from a lot of our 401k folks that are, 5-10 years from retirement. They log onto their 401ks recently, and even if they're in a target date and they open up the hood and they see, PIMCO as the fixed income allocation, or it's Vanguard Total Return Bond Fund, right? They're seeing about a 10% loss on paper. Again, for those on the call, that's really because as the Fed is increasing rates, the bonds that are currently held on there are now worth less. So you're feeling that hit on the mutual fund. So just to kind of explain that. So I guess the question the 401k our folks have is, if it's a 10% loss, what do you think? Is there going to be more increases? Should I get out now and wait until, obviously we don't want to do that, and I want you to talk about that, but are there going to be more Fed increases? Are the ones that were already just happened priced in, obviously? How much more is there going to be? And, what's the time frame most likely to your expertise that I might recover that 10 and get back in the green? When is that going to, have to turn over? How much time is that going to typically take?
So no one has a perfect crystal ball, but essentially a lot of the bad news has been priced in. So folks here on this call have seen movement in their bond funds, right? They've seen, like you said, the price go down. They've seen those yields go up to, 3.5%, 4 in some cases, depending on the type of fund you have. But you haven't seen that price movement yet on your money market funds, right? You haven't seen that price movement yet on your bank savings. So what happens in the bond market is the bond market gets ahead of the Fed, right? They don't wait for the Fed to actually hike rates. They start to move those yields up. And so because that yield movement has already happened, again, it's fair to think about that the majority perhaps of the bad news has been priced in. And again, just remember, think about it like a teeter-totter, right? Yes, the price goes up, but my yield goes up. The price goes down, but my yield goes up as well. So if you're able to hold on, 3, 4, 5 years, you will, have a good chance to recapture that return over time. And by the way, right now the economy is still fairly strong. The job market, as you know, is fairly strong. We are still growing. But if the Fed makes a mistake here, if they slow the economy down too much, if they tighten financial conditions too much, and we end up spilling into a recession in the next 1, 2, 3 years, then you could potentially see that, a lot of that price movement reversed even more quickly. So the way we would phrase it is, look, if you've been underweight fixed income, and Chris talked about some of just the incredible price appreciation we've seen in equities over the last 3 years, then this might be a time, given where yields are, to think about moving a bit closer to neutral, right? This might be a little bit of a time to think, gosh, my target was 60-40. I've drifted to 75-25. Maybe I want to rebalance at this point and capture some additional yields, right? I'll tell you, in my personal portfolio, just earlier this week, I had a decent amount in cash that I was looking to leg into the bond market. And I don't know if I caught it right or not. I'd love Chris's take from a multi-asset perspective, but I put that into bonds. And so, we'll see if if I look smart or dumb a year from now.
I feel like, I don't know, I get this a lot. And I was thinking about this morning as we were getting ready for the call, because obviously Brian and I have people reaching out and they're concerned about what's going on. They see the value of their account dropping. Obviously, there's a difference between the value of your account, the value of your investment. I mean, that can be reduced in value, but you still hold the shares, right? The underlying asset itself, whether it's fixed income, whether it's stock or ownership in a mutual fund, you still have the same number of shares. You haven't sold the shares. It's just the value has gone down. I feel like there's this, it's almost like we're too tied in because we can just log into our accounts and see, oh my goodness, the value is dropping. I need to do something. Like there's not really any other, what we would call an investment, where we could just log in and see the spot price, right? Day in and day out. It almost drives a lot of this, that fear mentality that you talked about. I mean, there's an emotional cycle to this. I know Brian and I have talked about this in one-on-one meetings, really the importance of staying disciplined regardless of where you're at, and not making these emotionally based decisions, regardless of what investments you're in, I think is really huge. I know we had a question come in a little while ago, and maybe I'll defer over to you, Chris. What should somebody do who maybe went a little more aggressive, or maybe they invested money, we'll call it a year from now when equity markets were looking really good? How do you think about that when right now maybe you're down in value? Is this a time to ride it out? I don't want to put you on the spot here. Again, we always say we don't have the crystal ball, but like, how should somebody be thinking if maybe they got in kind of late after a lot of the run up and now they're seeing a reduction in value?
So a couple things. So one, I'm obviously going to have a favorably biased opinion of the firm that I represent, but I will say that T. Rowe Price also has a quite favorable opinion of PIMCO. So that's fixed income, and we do fixed income, and I'm multi-asset and equities as well. But the reason why I say this is, that environment where we were getting 17% return in the equity market for a long period of time, and then I mentioned up 81% since March 23rd, 2020. This has been an environment where just an enormous amount of liquidity has been pumped into the system to combat the economic ravages of COVID-19. We added up the amount of stimulus globally that went into the markets beginning in the spring of 2020. Something remarkable. $28 trillion pumped into the financial system is the reason why the market is still up 81% since March 23rd, 2020. But the reason why I mention this is you did not have to be a genius in the stock market to make money in that market. You just had to throw your money in, and it was a rising tide lifting all boats. Well, that liquidity has been coming out for the better part of a year now, and now the Fed is raising interest rates, meaning now it's not only a stock picking market, it's a bond picking market. Roger, I'm also with you there on the Peloton, and I hope our company stays in business because I love the product, but now they need a capital injection. But what I'm saying is now we're going to get a real credit cycle. There are going to be defaults, and there's nothing wrong with this. This is how capital markets work. This is how capital gets allocated. There's going to be a credit cycle. Bonds are going to get repriced, and some people are going to make it. The others aren't going to. And an expert like PIMCO is going to sift through that. For T. Rowe Price, we're going to be picking stocks. But back to that question of, what do I do in this market where it's going to be choppy and the roll-aids, we're all going to need them this summer as the Fed is raising interest rates and markets can go lower here. This is an opportunity to what we call dollar cost average. Do not pull back on your contributions to the market with a time horizon. You are buying if this market keeps grinding lower, you are buying at ever lower prices. To the extent that we get some blips along the way, it just smooths out your purchasing. But this is an opportunity as a strategic investor to get a better price on your investment. So for that one question, do I shy away from the market and reduce investments? Absolutely not. This is the time to make hay in the capital markets. And Stuart, that's the question you were referring to, I believe.
Yeah, I mean, it's funny. There's that Warren Buffett quote. I think it's be greedy when others are fearful. Wasn't that was a Warren Buffett quote, I think?
Yes.
I think it's
and the reverse, be fearful when others are greedy, right?
Yeah.
Yes.
Yeah, you could flip it on its head. I mean, that's kind of the approach you have to take. And I know one of the things that we really emphasize just when we're talking to people, even pre-retirees that might be a year or two out and they're seeing this volatility, remember, when you retire, you're not just taking all of your money out day one or the first year you retire out of a retirement account. It's got to last you through retirement. And so keeping that very long-term perspective really can help, I think, assuage a lot of the concerns people have. If you look at it past just, hey, the next 1 year or 5 years, you still have a long time horizon. You care about where this is all at 20, 30 years from now, which I think it's safe to assume the market's going to be a lot higher than it is today. So
Stuart, Brian, so that long-term and love all the comments, but also saw a question come in on somebody with a bearish view with a very short-term horizon. I'd be interested for Roger's thought here, but I think, I don't want to duck that question, and I see it, and I'm intrigued by it. But in the 401k space, and stable value is a great asset class to hide here. Take advantage of that in your 401k. And aside from that, limited duration inflation protected bond is a way to preserve assets here if you have that view. I just saw that question come in. I was intrigued. Roger, I don't know if you have a thought here.
Yeah, no, I agree with that. Certainly, inflation protected bonds, if you have an option like that in your portfolio for, long-term inflation protection are interesting. I think with stable, the only thing you need to think about with stable value relative to bonds is that, again, nobody's talking about necessarily a recession anytime soon. But if you have your stock bond portfolio and we do have a recession, an economic event, a tragic geopolitical event that's even worse than what we've experienced so far, then you don't, the bonds in your portfolio at 3.5 can appreciate in price, right? They can go down to a 2.5% yield. That gives you that 1% will give you a 5% boost to your bond portfolio when other things are selling off. And I think that's the only trade-off when you think about, shorter term allocations relative to longer term allocations in bonds. And and then again, maybe I'll just add one comment earlier to Stuart and Brian's question. And this is similar to some of the points you made, Chris. And by the way, the respect is mutual and the love is right back at you. Is I would note that, when we were investing in low yielding bonds in 2020, right, in the heart of the pandemic, and people were saying, oh gosh, this bond investing stuff is easy. Yeah, I'm only getting a 1% yield, but look, rates came down to 0.5% and I got another boost to my portfolio. So it's easy to make, 3 or 4% when, bonds are yielding 0.5%. A colleague of mine used to have this saying that you can't go to heaven twice for the same good deed. So we went to heaven, we did our good deed, we got the price appreciation to the bonds, but then yields go down and the future returns go down. So what is that? That's like another mathematical way of looking at what we said earlier, which is, look, the main thing, at least on the bond side, is what is your starting yield? What is your starting yield today? Don't worry about it. Come back and look at it in 5 years. I bet you your returns are going to be, 3.5%, 4%, and maybe a little bit higher if you got a good portfolio from T. Rowe or PIMCO that picks some good bonds. But it's really going to just correlate to starting yield, just to really try to simplify if there's one takeaway.
Yeah, let me jump in here. We're getting some really good questions as far as, some older folks, right? Those are obviously the people who tend to be more worried, right, with all the volatility happening. Hey, I gotta turn this into an income stream in a couple of years, and that's concerning. I don't have 20, 15, 30 years to ride this stuff out. And that's where, again, where Stuart and I come in on the certified financial planning side, whereas obviously we have guys like Roger and Chris that are more on the analyst side that are watching all the, stocks day to day and the technicals and the fundamentals, et cetera. But for those that are retiring, first off, you need a plan, right? So let's say you're retiring in a year, is your spouse still working? Where are you going to live? What debts do you have? What income stream do you need? What other income streams do you have? Do you have pensions? Do you have Social Securities? But as far as your 401k nest egg, when are you going to take income and how much do you need? Those are really the two main things that Stuart and I need to know. If until we know the answer to those questions, it's hard to give you any. We can't give you any recommendations, right? It'd be malpractice without knowing your plan. So that's really what our value is, and I can tell you that dealing with 401ks tend to be plain vanilla as far as the things you can invest in. So as our retirees and our plans tend to get older, we tend to broaden them out into other things and other asset classes you can't get inside of 401ks. And I'll give you a prime example. Obviously, you take your normal 401k bond fund, intermediate term bond fund, it's down around 10% this year. Large cap value, large cap, growth is down around 10, 20. But you look at some other asset classes like commodities, for example, a commodity tracker, like if you ever look up DBC, it's an ETF tracker, that's up about 35% this year. So as clients get closer to retirement, we tend to diversify them beyond just your basic intermediate term bond fund and your S&P 500 fund. So when we know you need income, like my clients right now that are taking income, guess where I'm not going? I'm not going to their Vanguard Total Return Bond Fund. I'm not going to their S&P Bond Fund. I may be taking some income off of those, and I'm not reinvesting and just taking those checks, but I'm pulling from the things that are up at the time, which allows my money to last a lot longer throughout retirement. So we've all heard the diversification talk before, but that's where it becomes very important for retirees, right? Like, again, stocks are down, most bond funds are down. Again, if you have a TIPS fund, which is Treasury Inflation Protected Securities, that's only down 1% this year, not 10 like an intermediate term bond fund. Hell, even those that are on the phone, I'm sure plenty of these people dabble with crypto. That's obviously getting taken pretty good this year as well. So if you're dabbling in other asset classes, that's what we make sure we do for clients so we can get the money. And I think all three or all four of us on the phone would agree, none of us know when the market's going up, down, or sideways, but we can guarantee and agree it'll do one of the three, right? Like it's going to do one of the three. So the whole point is let's plan a portfolio of how much you need and when, and we diversify it. So if we do end up in a market like right now and you need income soon or today, we have efficient places to go and get it where we're not drawing at things at a loss. That's where a lot of people get hurt, is they draw while their money is going down on paper and they're locking in those losses and they're running out of money a lot faster. So let me throw a question to Chris. I get this from some clients too. The NASDAQ. I mean, that's what's taken the big beating, right? Is all the tech stocks. I mean, I think the NASDAQ is the biggest index, that's down so much this year. So talk to me more about a little bit. I'm curious. I get this from some investors. Say, a lot of people want to do passive investing in the last 10 years, right? That's all the craze. Lower the fee, get into passive. But what's that really done? Obviously, is that's really ratcheted up the value of these tech stocks because they're such a big part of the market with so much money going into passive. What do you guys see as far as the NASDAQ's future and passive kind of building up all these tech stocks?
So I guess there's a lot to unpack there. Thanks for sending the puck my way. It is Stanley Cup playoff time. Why don't we get to like the technology side of the question? Is I think we've unpacked the technology stocks that are a big part of what's embedded within your question, and I think we unpack it really into three tiers of tech stocks, and which impacts growth in a big way. But we would call them it's the FANGs, like Facebook, Amazon, Netflix, Google. We all know the acronym, and those are the stocks that have been running hard and they've rolled over from a year-to-date perspective. But there's three dimensions of tech, so we would call them the baby FANGs. And Brian, this gets to the heart of your question. The lowest quality, non-earning part of NASDAQ, and the more disruptive the story in terms of some new technology, even though money wasn't going to be made for 10 years, the more that was amplified in the story when money was free, the better those stocks ran. So I'm not here to disparage a certain technology fund, but there is one high flying fund that I will stop short. But I hope everybody can fill in the blank. That fund is down 70 or 80% over the past 12 to 18 months. And that portfolio or that fund is very representative of what we would call the baby FANG stocks. A lot of non-earning technology companies that were very much rewarded in the height of the pandemic, where those stocks were mostly rewarded. But now money is no longer free, and that portfolio that I'm talking about now down 80%. And I guess in terms of the baby stocks and the washout in the NASDAQ, we would say that's like we're in the eighth inning of that story. But while we're in the eighth inning of that story, we're also saying that you don't go buy those stocks now because now money is no longer free. And if they're not going to be making money for 5, 7, 10 years, some of them are going to go out of business. We are going to have a cycle, an investment cycle. So there's the baby stocks that are washing out washing out in NASDAQ right now. And then we would call them the almost FANG stocks. So software stocks would very much factor in here. So this would be your Salesforce, your ServiceNow, the symbol CRRM. Those stocks have had a big correction pullback from a year-to-date perspective. But I would say now here, T. Rowe Price is very interested in these types of stocks. They are been reduced in price. And in terms of they all are factors in participation of major corporate America moving their technology infrastructure to the cloud. This is a story that's maybe in the third inning, and these software stocks are right in the middle of that. So quite constructive there. And then finally, you get to the FANGs themselves. They've had a tough year-to-date experience. But what's interesting in terms of passive versus active is now those stocks have pulled back. And your Facebook, your Amazon, your Netflix. Let's leave Netflix out of it. A little bit of a different story, but certainly Amazon, Google, Microsoft, they've become so attractively valued. You're soon to see them in value indices. So if they leave the growth side and you're an active manager, you now need to make a decision. So passive, it was fine. That world where the market was up 17% per year, all the way back to 2009 coming forward, that's where we were. But where we are now is valuations have changed, and now passive no longer captures the opportunity. This becomes a stock picker's market. So 3 tiers of tech. You had the big washout, but don't go invest there. Almost FANGs, very attractive opportunity. And then big tech. And then what do you do with it? You either play at value or growth. This is a fertile time for active management. So Brian, I hope that gets to you at the heart of your question.
Yeah, and I agree with you. Again, I think with a lot of assets going passive over the years, because again, it became a big fee conversation, which was fine for a while, but as putting so much money in passive, it's really built up those tech stocks. And I think that was probably part of the reason that they went up so as fast as they did. And now I certainly agree with you. Active management certainly has a part to play in anyone's portfolio. I saw James ask a good question here as far as like the Dow's down, S&P's down, should we be in commodities? Again, I'd go back to my point that money typically goes somewhere, right? So while bonds as a whole are down, stocks as a whole are down. Again, commodities are up depending on the index that you're using for the given year. Energy's up 30% this year, the energy sector. So as long as if you need the money and you need to draw from something, it's a big key that we spend with our clients to make sure that we're diversifying so we can take it from somewhere safe. Because something's always going to go up somewhere. You just got to make sure you're diversified and all this stuff to make it happen. So should we be investing in commodities? To your question, it obviously, first off, it depends on your situation, right? But if you're close to needing income from a portfolio, I would say yes. But one thing I would say is, well, Brian, why wouldn't I invest in commodities long term? The 10-year return on commodities is like 1% versus the S&P is like 17 to Chris's point. So it's not something like if I'm coming on 40 years old, so I'm not touching my retirements. They're all in stocks. I'm getting let down like everybody else, but I understand how they work and I let it go. So because I know stocks long term, they're going to have those really good long-term returns. But as you get into the point where you're going to start to need income, that's where you diversify these other asset classes that aren't really good long-term players, but they're good places where money tends to go in environments like this, so we can have efficient places to take money from.
So Brian, one thing on that, no, Roger, if you had something, please go, because I've been talking, but
yeah. Well, I was just going to expand a little bit upon sort of this idea of having a broader opportunity set. And Brian, you mentioned earlier about, sort of the opportunity set beyond the standard, index S&P 500 fund or the standard index bond fund. On the bond side, I do think that's important, right? Because those kind of plain vanilla core funds will dabble in treasuries and some corporate bonds. But if you look beyond the US market even, right, globally, the bond market's $123 trillion. And you have, massive bond markets in Europe, in Japan, in the emerging markets, in Brazil. Now you've got China growing to become 15% of the global bond market. There's a really rich opportunity set. And if you can invest in some, less liquid investments, in some higher yielding parts of the mortgage market, even the mortgage market, by the way, it wasn't that long ago that the 30-year mortgage, rate was 3.25%, and now it's up to like 5.5%. Now, why is that relevant? Because when people take out mortgages, let's say Stuart, Brian, your mortgage might very well be one of the 150 million mortgages that we're tracking here at PIMCO in our database. And so these higher yielding mortgages turn into higher yielding mortgage bonds that we can all invest in. And so if you work with Brian and Stuart, you find some higher yielding income funds, like the PIMCO Income Fund, for example. You can find some really, really interesting global opportunities, sector-specific opportunities, some really interesting corporate opportunities that you don't benefit from in the more traditional bonds. And again, just to give you a number, right? The 10-year bond is, the government bond is yielding less than 3% today. But with, again, active management and a broader opportunity set, you can get up to 4.5%, 5%.
So at what point do people start buying the dip? Like that's kind of the question, right? Because I have clients that some of them, we wanted to dial it back, December, January, right when the Russia-Ukraine thing started, everything slid, equity-wise, even fixed income slid a little bit more since then. Like, is it too early to be thinking, hey, we could start buying the dip, or are we still trying to avoid catching the proverbial falling knife?
Except for
Yeah, you,
Roger.
Chris, yeah, bake that into your question.
This is being recorded, Chris. Just
Yeah.
One, I think Roger made a lot of good points, but the only other thing before I dive into Stuart's question is on Brian's question on real assets. Brian's 100% correct. Like, real assets or commodities have delivered you nothing for the past decade. But there was a moment in time of the decade of 2000 to 2010 when you had something called the super cycle. And this was China building out its urban infrastructure, and real assets or commodities were an enormous part of that construct. Well, that was 10 years ago, and China's already done it. So why am I talking about it? Well, two reasons. So one would be something called energy transition. This whole world of green energy and where we're going, electric vehicles. I don't have the exact number, but it's an enormous number. $25 trillion is going to get spent in the next 15 to 20 years on green everything. And in the middle of that energy transition, copper, aluminum, lithium, nickel are in the middle of all of that. So there is a catalyst for commodities from a go forward. And then the other thing would be Russia, Ukraine. That situation looks protracted and it's not going away. And you were getting a lot of commodities out of Russia. And meanwhile, you have Ukraine is the breadbasket of the world. But the conflict's not going away. And Russia is now a pariah state getting cut out of the global financial system. Meanwhile, half of the world has yet to condemn Russian aggression in Ukraine, meaning it's almost like Cold War Part 2. Why do I mention this? Well, you're going to need energy infrastructure built in Europe to work around not getting Russian energy resources. That's going to require aluminum and copper. And so anyway, you got this, energy transition is a catalyst for commodities. And then the Russia, Ukraine, and a Cold War II, you need that. But now let's get back to Stuart's question. So about buying the dip, and I guess Stuart, look, Roger knows this as well as I know this, but like, bonds are all about cash flow. There's the par amount, but then you're getting a coupon along the way, and then hopefully you get your principal back at the very end. But stocks aren't that different. I mean, you invest in the company, but it's a series of earning streams. That's what gives you your price of your stock, which gets me to, how do you gauge, do I call the bottom of the market here? And that brings me to earnings in the S&P 500. So, right now, the Fed is raising interest rates. Economy is slowing. Last year, earnings growth in the S&P 500 was about 60%. So there's this aggregate number of earnings in the S&P 500. It got as low as 130 at the end of 2020 because of the pandemic. It's now 200. So we've had 60% earnings growth, just an unbelievable number. But there's a lot of headwinds and a lot of uncertainty in the market right now. Right now, consensus on the street is saying that S&P 500 earnings are going to move from 200 to 237. That's 18% earnings growth is now baked into the cake. Does anybody on this call think that the S&P 500 in this environment is going to deliver 18% earnings growth? I'm not here to raise my hand. So to the extent that needs to get calibrated and we get a handle on the Fed, that question back to dollar cost averaging, it's that environment. But calling the bottom here, and T. Rowe Price isn't on, I'm not going to put T. Rowe Price on the tape here, but there are some at T. Rowe Price that 3,500, 3,600 in this environment, you can be dollar cost averaging through that. But with earnings expectations here relative to a different reality, it's tough to call the bottom here, Stuart. So I'm out of breath. I'm sorry.
Love it. I love it. I mean, that's what people want to hear, right? It's kind of that those earnings expectations are driving a lot of this. And that is those are bullish price targets kind of across the board you're talking about.
I'll just add, sorry, just to jump in. Like, again, it's really hard to call any specific bottom, particularly for us on the stock market, but on the bond market either. I will say, again, using myself as a bad example, I had a portfolio that was, should have been, call it 50% stocks, 50% bonds. It was 50% stocks, 25% bonds, 25% cash. I went back to neutral this week. So, Chris is right. More often you don't make these violent swings. You sort of ease into them. But if you're below your targets, right? If you're a young person and you don't have enough stock, or if you're someone closer to retirement, you don't have enough income generating investments, probably reasonable time to move closer to neutral, right? Probably,
Yep.
at least it was, I thought in my case.
I mean, I can tell you on my end. I mean, I put a good chunk in my retirement account this morning. I mean, I always talk to clients about the gas versus the stocks, which is funny. Like, gas prices have been through the roof. We've all kind of felt it at the pumps. And every single other social media post when I check my stuff is someone complaining about gas prices and how they don't want to pay it. But then they see their stock stuff losing money and they want to sell it, which is two counterintuitive problems, right? So typically in the history of investing, where most people tend to get hurt is they see the negative and they sell, right? They sell low, buy high, right? That's always what we want to try to obviously mitigate to some degree. But as I just threw in money this morning, if it goes down another 20%, it goes down another 20%. But I know at least today I'm going to the mall at a 20% discount, right? So I'll take the discounts where I can get it. But again, most people tend to wait until it's going back up in those higher prices to do it. So make sure you're very cognizant of that. Always look for the distressed asset, right? Warren Buffett always talks about that. The biggest mistake I often see in our 401k plans is, like, I meet with someone for the first time and I look at their allocation. I say, how'd you pick this? And they said they looked at the returns chart and they put their assets in the one that did the best the last year. That's usually not in your favor. Maybe large cap growth was probably an anomaly in the last couple of years. Large cap growth actually did that. But for most cases, if you chase the things that are doing well, like commodities have done really well. So no one on this call should go run and put all their money in commodities. It's just about having a piece of the pie there. So look for always look to buy things on discount, just like you're going to the mall and you'd rather go to the gas pump and see your prices down. And there was a good call or a good question that came in as far as, should I go into bonds from stable value? I would tell you, just to answer that question, you guys can give your take on that answer in a second. But if you're 15 plus years away from using the money for any degree, especially if it's 401k money you can't touch till you're 60, I wouldn't touch bonds with a 10-foot pole. No offense to Roger. You don't need that asset. Like, stocks are going to outperform bonds long term, or at least they historically always have been. But once you get to within that 0 to 10 years of using the money, especially 5 years or under, that's where you need to start turning your investments into like a rental property. And you need to start generating income for you. The companies need to be paying you in terms of value stocks and dividends. Your bonds people need to be paying you. So once you get within 5-10 years of needing the money, that's where we tend to shift clients into bonds. And then these days with our retirees, we're starting to build individual bond ladders and doing bond ladders, bond barbells, things that are a little more, and what that means for those on the call is, instead of in a bond fund, you don't actually own the individual bonds. So when we build you your own bond ladder, we control holding that bond all the way to maturity. Where in a bond fund, we don't have that discretion. So it gives you a little more opportunity to make sure that you're not getting the principal effect of rising interest rates.
So, Brian, the only thing I'd say from a stable value standpoint, and be interested for Roger's take here, is look, amid the volatility that we're operating in right now, which looks to exist through the summer, stable value is a fantastic place to hide from market volatility. But Roger's mentioned this, and T. Rowe Price is going to mention this as well. We're of the mind that Fed funds is on its way to 2.5%, potentially 3%, and there's going to be a moment, and if a 10-year Treasury yield gets into the 3.25% range, the beautiful thing about stable value is the yield kind of locks in and it doesn't move a lot. But if rates move to a certain point, stable value stays here, and then your conventional fixed income portfolios are going to handsomely out yield stable value. And this is imperfect. This is impossible to perfectly time, but as the Fed is doing its thing, there's going to be a time where you're going to want to transition out of stable value into conventional fixed. Roger, I'd be interested if you would agree.
Yeah, I mean, again, I think they just stable value and call it longer term or intermediate term bonds just play different roles in a portfolio. I remember back in when the first tech crisis kind of blew up in the early 2000s. Late 90s and early 2000s. I personally had some money in stable value, and I was very grateful that I did at the time. But at the same, but by that same token, right? If you really do, the reason that insurance companies and corporate pension plans and other people invest in bonds is because you need something that will go up in price when stocks sell off. And I think that's the main appeal of the bond side of the equation. I did see we got a question about short-term to long-term bonds. It is an interesting time right now to be looking at short-term bonds because normally long-term bonds yield a lot more than short-term bonds. In this environment, short-term bonds are yielding almost the same as long-term bonds. So it is an interesting time to be looking at short duration bond funds because you're getting decent yield without taking on a lot of risk.
And I had talked about tips earlier. I want to be clear on my point. Limited duration, short maturity tips. We're of the mind at T. Rowe Price. You get beyond 5-year maturity tips and you're getting something that you don't think you're getting. You're not getting fully compensated for inflation as it plays out. But I'm talking about short maturity, limited duration tips. That's the nuance. But I mentioned that nuance relative to you get some inflation compensation. And to Roger's point, it's a flattening yield curve and not much separating short duration fixed income from a long duration standpoint. And yeah, I couldn't agree with Roger's point more.
Well, I think we're about out of time. I love the conversation. We're getting a lot of great interaction just through the chat feature, which we've come to know and expect that now. And over the course of doing these podcasts, it's awesome. Last question, I'll just kind of throw out to the group. It came in through one of our chat features here. Is there an inflection point? I'll ask both of you where we expect things to kind of turn around, or what catalyst has to happen to maybe switch some of this volatility and maybe we start to see things move in another direction. Roger, I'll start with you. Chris, I'll close with you.
Well, I'll give you one catalyst, right? So we saw a big 8% plus CPI number yesterday. If the Federal Reserve is successful, right? If supply chain pressures ease up in China, as Chris mentioned, we're probably in for a long slog with Ukraine and Russia. But if there's some stabilization there, if there's some economic move lower in inflation that sort of stays down, then that's a very interesting inflection point for the markets, right? I think the markets are still very comfortable that the Fed's going to beat down inflation, but it'll be more comfortable once we actually see those results materialize. So I'll give you that inflection point. It's not a number. I'll look at Chris.
So the Atlanta Federal Reserve Bank has done everybody the service of breaking inflation down into two components. So they have something called the flexible CPI, and they have something called the sticky CPI. And I'm going to latch on to Roger's point here. So the flexible CPI number from the Atlanta Fed, it very much are components of inflation that move on a real-time basis with things that are happening in the world right now. So supply chain problems in China, impacting shipping rates and impacting the global supply chain. Not enough used cars, like all of those things. But that Atlanta Fed flexible CPI number is right now north of 20%. And from our perspective, and that's just an enormous number. Like, this is early 1980s stuff, and I'm old enough to remember it. Roger, I think you and I don't know if we're like close to peers, but yeah. I don't know. Freshman in college, 81. Yeah. So anyway, whatever. But this is inflation like that. But we're of the mind that we are reopening, and I'm doing client meetings with no mask on again, and it's COVID is the driver of that flexible CPI of 20%. And last year it was like the U.S. distribution network was driving that 20%. This year it's China. Keep an eye on that 20% flexible CPI number, because that is what's driving headline inflation north of 8%. As that moves, that's the tipping point for Roger. That takes pressure off of the Fed. So our worst case scenario, that Fed funds get to 3.5 this time next year. But if China is able to get to the other side of COVID and that flexible CPI number starts dramatically falling backward next year, there's no way in the world Fed funds goes to 3.5. And to the extent that then it's only 2% Fed funds and something in terms of stabilization, Ukraine and Russia, I could see the market up 10 to 15% on that news alone.
Great takes from both of you. Brian, any final words or things people should think about?
Again, I'm actually down here in Alabama, and I just had benefits fair for one of our big K-Plan clients yesterday. They got a couple thousand employees, and a lot of them obviously came to talk to me about the retirement plan we manage for them. And really the big takeaway is, if you can, as long as you can afford it financially, make sure you continue to add to your plan. Now's the time you want to keep adding, and you want to keep adding more if possible. Try to up that contribution from 5 to 10% or something if you have a ability to do it, obviously. So that's something I would do. And then again, if you have a long-term track record, 15 plus years, I'd still stay heavily invested in stocks. I think all four of us can agree with that. And then once you get within that 10 year window, that's where you really got to get with an advisor, a steward or myself, and, really make sure you're getting a plan in place of, what's the number I need, and how do I turn that money into the X amount of money I need when I retire, when I need my income. But again, key takeaways I would say is make sure you contribute, give more if you can, and stay the course through this. And if you are getting closer within 5 years, make sure you reach out to us and have a consultation.
I love it. Well, thank you all for joining us. Excited to see everybody back next quarter when we do our next quarterly podcast. Roger, Chris, thank you very much for your time, your expertise. It's enlightening. And book an appointment. If you haven't talked to Brian or myself, as Brian mentioned, if you're close to retirement, shoot us an email or take a look out for one of those one-on-one appointment dates at your company when it becomes available. Take care, everybody. Have a great rest of your week.
Yeah. Thank you, everybody.
Thank you.
Thanks, Chris.
Bye-bye.
Thanks, Roger. Appreciate it.